Futures trading involves risk and is not suitable for all investors. Content provided in this segment is meant for educational purposes and is not a solicitation to buy or sell commodities.
Hello and welcome once again to Pasture to Pin, a new series from the EverAg Insights team. Each week we bring you news and updates on the cattle markets with the intention of helping cattle producers manage their risk. I am your host, Michael Todd Rowen, coming to you live from my home office in the Texas Panhandle. Before we get rolling, let me timestamp this episode. Today is September 5th, 2023 at 3:03 in the afternoon. This episode's guest will be none other than the connoisseur of all things Chicago Cubs and EverAg's Senior Director, Mr. Jim Sullivan. Jim, welcome to the show.
MT, thanks for having me, man. Cubs are currently in playoff contention, so I'm a happy guy.
That's all you can ask for. Happy to have you here today. Kicking off this show, we will be looking at pasture conditions and weather. Pasture conditions have slipped since the last episode. We have 36% of the U.S. pasture condition in the good to excellent category, a decline from 40% since last episode. Some standouts in the good to excellent range are Nebraska at 52% good to excellent, South Dakota at 54%, Utah a much improved 67%, Colorado at 73%, and category best is still Wyoming at 88% good to excellent. At the other end of the range, 37% of the lower 48 is in poor to very poor pasture condition, an increase of 5% since last episode. Not a direction we want to be headed. Some standouts in the poor to very poor range. Texas tops the list at a whopping 78% poor to very poor. Persistent drought and heat in the central part of the state is really leading that percentage. Washington comes in at 61% poor to very poor. Louisiana, surprisingly, is at 57% poor to very poor. Arizona has had a dramatic turn of events with 53% of their pasture condition in poor to very poor category. And ending the list is actually Minnesota at 49% poor to very poor. As we look at the 7-day forecast, most of the plains could see some relief to the summer weather, as most could get, probably a quarter of an inch to some showers within the week, up to an inch of rain from southern Nebraska all the way into north central Texas. We are finally seeing a break from the summer stubbornness, which looks great post-Labor Day. Switching to the futures market, given that Trey is out, I will be giving the futures update for this episode. Since July, feeder futures have really been trading in a sideways channel, posting a low of 243.65 and a high of 257.02. October feeder futures have been higher 5 of the last 11 trading sessions and breaking through key resistance at 252.150. For live cattle, futures have also been trading in a sideways channel since June, posting a high of 181.5 and a low of 178.15. Since August 7th, October live cattle futures have fared a little better than feeder futures, trading lower in 10 of the last 21 sessions. However, after also gapping higher since the cattle on feed report on 8/18, October live cattle futures have been higher 7 of the last 11 sessions, breaking through key resistance around 179.75. Typically, the month of August is a lull for futures as it is for cash. As we wait to see how the fall run takes shape, likely this week, and wait to see how the corn harvest will fare as we get further into the fall. Feeder futures will definitely take their cue from cash. A run-up in cash prices will likely spark more bullish sentiment on the feeder futures front. Any spike on the feeder board will trigger big gains in the deferred live cattle contracts. As the August live cattle contract has expired, look for traders to lead the way with October fats, but in a non-contract month of September. Hedgers will likely remain on the sidelines as we continue to see live cash cattle above futures. Switching to the cash market, the CME Feeder Cattle Index 7-day average finished last week at 248.74. Last week's sale at Oklahoma National was still towards the lighter side with 6,000 head in volume. Most of the volume looked to be heavier weight feeder cattle with prices $1 to $3 higher than the week before. Live cash cattle prices have softened just a little bit, with prices in the north coming down well under 190. Last week, northern cattle feeders traded at 184 to 187 live, $1 to $4 lower, 292 to 295 dressed, again $1 to $4 lower as well. In the south, cattle feeders traded cattle at 178 to 179, 1 to 2 softer week over week. These lower cash prices have brought the 5 area weighted average a couple dollars lower to 182.34. Cutout prices, however, continue to impress. Typically, July and August will bring lower cutout prices, typically dipping below 300. However, this year has presented more of a contra-seasonal pattern, with July and August reinforcing prices above the 300 mark. This 300 mark has been in play since the month of April. Today's cutout prices posted even more gains. Choice remained above 312 at 315.48, while Select came in today at 289.54. However, the Choice Select grade is not the only category continuing to stay high and continuing to impress. The 90s trim is on a historic run. And here today to talk with us more about the meat side of our industry is EverAg's Senior Director, Jim Sullivan. Jim, thank you once again for joining us today.
Hey, thanks for having me. Always a pleasure to join this spot. What I wanted to just touch on briefly today, you mentioned the cutout just being on a tear, sort of diving into that a little bit more. And we think about cheeseburgers, right? Ground beef. Typically what you need a blend of some fatty trim and some lean trim to get your perfect burger patty, right? So 90s lean beef trimmings is one of the main prices that people watch. And what's really impressive when you look at the chart, only 3 times since this current report, since 2003, have we printed, above $3. Or one of the times was recently, obviously in COVID. We don't need to rehash that one. The other time was in 2014 and the beginning of 2015. Why I bring that time period up is because I think, some of the stuff that we're dealing with right now is similar to what we were dealing with back then, right? You had the herd contraction going on. You had the price of cattle going sky high and so on and so forth. When we look at it even more deeply, fresh 90s beef. So when we look at this chart here, looking at the seasonal patterns for lean beef, typically we'll see the prices rise. We start firing up our grills in the spring. We have our barbecues in the summer, and then right around this time of year is when prices start to fall off throughout the fall and really sort of leveling out to end the year in the winter. That has not been the case. So let's take a look at, what do these prices look like, the rise that we've seen this year versus 2014. And you take a look at this chart and it is similar, right? We saw prices rise rather dramatically in July and August in 2014, just as we have this year. What we're seeing right now, and which I think is going to continue, is a similar pattern that we saw in 2014. You're not going to see this seasonal break. Prices are likely to remain at or near this all-time high level above $3. Again, we just recently set a new all-time high on August 28th at $3.10 a pound, which is a new all-time high by just a bit, right? And then last week, we continued to trade above $3. I don't see that breaking anytime soon, for various reasons, which we'll talk about in a little bit. But so when we think about it, if we're likely to continue seeing high prices for beef, particularly for lean beef, through the end of this year, when might we expect to see them break? That's the burning question right now, MT, is that, if we're looking at it in terms of what happened last time, okay, so when we look at 2014, we stayed elevated through December. We were really high in January of 15, sort of leveled out and then fell precipitously with that normal seasonal break. In 2015, prices started to break in August, September, and they broke very hard to end 2015. I'm not sure that I see a similar scenario playing out next year, right? Because I think that we still have some contraction to deal with. And, we look at the kill numbers here. they're behind. So I think in terms of beef prices, especially on the lean beef trimming side here, we're looking at some expensive cheeseburgers from here on out. And it bears watching to see how we develop through the rest of this winter and then into next year to see when we might expect some relief.
Right. Thank you, Jim. To kind of move into what we'll call a coffee shop talk between you and I, even though this episode has strictly just been you and I find it interesting what you're showing. I find it interesting what you're saying, because we are having some of these very same topics of conversation on the producer side of the industry. As you very well know, and as you have already stated, we are in a very bullish market, and that bullish market is due to tight supply. Obviously, a tightness in cattle supply will lead to a tightness in meat supply. On the producer side, we keep trying to look at things that will turn this market. We keep trying to find things that will turn this market, but only seem to be stating bullish facts. Are some of the dynamics that we face on the producer side some of the same dynamics that are driving up 90s trim?
I think so, right? I was thinking about it from the global perspective. You look at Australia and what they're dealing with in terms of drought and their cattle situation. We source a lot of the lean beef trim here in the U.S. from Australia. Well, when you look at that, that's not showing you any relief. In fact, that is likely to contribute to prices continuing higher, right? So no relief there. Another thing that I mentioned before is domestically our kill numbers are down. That's not going to improve anytime soon, I don't think. So keeping your eye on that as well, right? If dairy cow slaughter drops off, that's another thing that's likely to continue to add fuel to this fire. The one thing that I thought of where we could see divergence between what happens on the producer side versus the end user side, right? If things get really bad, particularly next year, and it forces perhaps a plant to close because it's just not worth it anymore, and it just doesn't work out, that's where things can get disconnected, right? Because as we saw in the past, like we said with COVID, that was the last time we traded in this $3 range. With a plant going down or closing, that's going to put pressure, downward pressure, perhaps on the animal side, whereas the meat side, it's again, we're heading up. So the last thing I'll say, perhaps the solution for high prices is high prices. Perhaps we can see some demand destruction playing a part here. I'm not sure, because again, I keep coming back to the fact that we don't have the supply to get prices to move lower right now.
At this point, it's going to be something very catastrophic, and I don't like to use that word, but it's going to be something very catastrophic that's going to turn this market on both sides. I mean, a plant closure, like you said, will have a bigger impact immediately on the producer side, as far as feeder cattle prices, live cattle prices, but as far as affecting our meat cattle economy as a whole and collectively, it's going to be something pretty catastrophic that would turn this market. So, Jim, again, thank you very much. Happy again to have you.
Always fun to be here. Thanks, MT.
That is a wrap for this episode of Pasture to Pen. Thank you to all of our viewers for watching this episode. If you have not done it yet, hit the like button, hit the subscribe button, and click the bell to be notified of future episodes. Thank you again to Jim for joining us on this episode. A big thank you to Paige for always making us look our best. Thank you to Corey, Hattie, and the entire EverAg Insights team for making this show a reality. Until next time, stay safe and pray for rain.